Hello and welcome to Bloomberg Quint. The Bharatiya Janata Party government's second term begins with the final budget for the current financial year being presented. We had the interim budget and now this is the full budget which we will go by. What are the priorities that the government has laid out, and what do experts make of its commitment to fiscal consolidation? We'll be talking about some of that along with some interesting structural perhaps changes that have been introduced, such as the government deciding to borrow in foreign currency. Joining us to talk about all of that and more, Dr. Indira Rajaraman, former director at the RBI Central Board, member of the 13th Finance Commission and a veteran watcher of the Indian economy. Ma'am, thank you so much indeed for taking time to speak with us. Let me first get your broad impressions before I get into individual points. How did you see the budget, some of the numbers and some of the proposals within that?
Well, it was a very long statement, as you know, and it covered a very wide range of proposals, chief of which were the very clear attempt to kickstart growth, the corporate tax rate reduction, the reduction in the scope of the securities transactions tax, the effort to deepen the market for corporate bonds, to raise the statutory investment limit for foreign portfolio investment, all of these, and the tax exemption for affordable housing. All of these were a packet of measures designed to improve the access of corporate entities and of industry in general to financing, both domestic and foreign, and to improve the functioning of financial markets. So I think that was the major thrust. But when the finance minister claimed that the government was committed to fiscal consolidation, that statement was not quite right. Because the projected fall in the fiscal deficit to 3.3% of GDP was predicated on a nominal growth of GDP of 12%, which can't possibly be achieved.
Just to take that theme a bit further, ma'am, there are two aspects to it. One is that the headline number, at least for the last couple of years, gets projected with some very ambitious, math backing it. In this case, they are expecting more than 20% increase in revenue and in net tax revenue to the government. At a time when the economy is growing at these kind of rates, I think the first question immediately comes, why are we even projecting these numbers?
That's right. There is ambition in the projection of revenues. There is probably some understatement in the projection of expenditures. But at the end of the day, if we take these numbers simply as they stand and the deficit number simply as it stands, in absolute terms, it is 7+ lakh crore of rupees. If you normalize that by what is likely to be a more reasonable nominal GDP growth rate of 10.5%, not 12%, then the fiscal deficit is going to be 3.4% plus. So, and if you recall, in nowhere in the budget speech did the finance minister even refer to the fiscal deficit. It was added on informally after the speech ended. Of course, the numbers are there in budget at a glance. So I think the gaze of the government has shifted away from fiscal consolidation in view of the imperative to get growth kick-started. And the focus is on making, as I said earlier, through corporate tax reductions, through the improved access to foreign and domestic funding, the attempt is to get growth going, and fiscal consolidation has essentially been disregarded, I would say.
Ma'am, also on the revenue deficit, which I know the government has stopped targeting, but the number is actually higher than last year at 2.3%. So the attempt, for long periods of time to bring down the revenue deficit is derailed.
That's right. As you know, in the new version of in the amended FRBM Act, the revenue deficit is not even being looked at. But if we look past that, if we look at that as something that has not been focused on, has not been included in the fiscal responsibility bill, and we just look at the fiscal deficit, which is included, which is the focus, as I said, I would be very surprised if the fiscal deficit were anything lower than 3.4%, unless the nominal growth rate of GDP is realized, which is very unlikely. A 12% nominal GDP growth rate, when inflation has been projected by the RBI at 3.3% for the current year, implies growth of 8 to 9%. It's clearly impossible. Even the growth measures that the government has announced in this budget are not going to kickstart growth all that soon. So I think fiscal consolidation is certainly not one of the targets that the government had this year. But I must mention in this connection one thing which is positive, I think, which is that, as you know, in recent years, delayed payments by government to their suppliers and contractors has been one of the ways by which they have tried to paper over their expenditures to show a lower recorded fiscal deficit. This time, there is announcement of a payments portal where suppliers can put up their bills and be paid. If that is really done, and if payment delays are reduced, that will be a very good thing from a fiscal management perspective, but by the same token, it will also raise the deficit, which is a good thing. I mean, if through being transparent, you're declaring the deficit to be what it really is, and not what it is papered over to be, then that is a very good development. But on the whole, I don't think the government is bothered too much at this point with reining in the fiscal deficit.
Ma'am, how do you view this debate around the the extra budgetary resources pool? So they've made some change this time, which frankly I don't understand exactly what they're attempting, but they've said that they will be including the extra budgetary resources, which include the fully serviced government bonds in the budget estimate. But even beyond that, the bigger debate of is this legit capital expenditure? Is it not? How do you see that?
Well, I've written about this. What has happened in the last financial year was that the Food Corporation of India and Air India even have borrowed from the National Small Savings Fund instead of being directly subsidized by the government. So that is a shifting out of the government's own borrowing to extra budgetary sources, because otherwise the government would have borrowed and subsidized these organizations directly. So there is a lot of this going on. I don't know what they're going to do. They say that they're going to bring it all on budget. We have to wait to see what is intended. There's a lot that is not specified very clearly. But another major fiscal expectation is that 1.05 lakh crore will be raised from disinvestment, from strategic disinvestment. And one of the organizations, the PSUs, which has been mentioned in this connection is Air India. The budget speech was very short on details. It didn't explain why this kind of realization is expected in this budget year, when repeated attempts to disinvest in Air India have not succeeded in the past. So it has been short on details, short on failures in the past, and long on expectations. Which perhaps is the way to go when you want to give the government give the economy the business confidence that it needs. But from a transparency perspective, it would have been much better if there had been an open declaration of past failures and a determination to overcome those going forward.
Ma'am, there's also a large, number of about 90,000 crores still being budgeted from the RBI dividend. Now, some of this, I don't know, would probably, be predicated on what the Economic Capital Framework Committee actually recommends or doesn't. But then it was also mentioned to me that in a year like this, in any case, right, the RBI's income would have been higher, so the dividend potential may have been higher.
Yes, the dividend potential, the dividends that have been budgeted will probably routinely be met by RBI. Anything that the Jalan Committee recommends would be over and above that. So I don't foresee any shortfall on that front. 90,000 crores is a big number, but they'll probably achieve it this year. There are some other measures with respect to RBI which are worth mentioning, I think. One is that regulation of housing entities is now being shifted back to RBI from the National Housing Bank. This is a very big move. because initially it was moved out of RBI on the grounds that the RBI's regulatory gaze was too wide, that they needed to concentrate more on banks, and housing finance companies were moved out. So they are being moved back in. It increases the workload of the RBI enormously, I might add. The other is that the regulatory powers of the RBI in respect of non-bank finance companies are going to be strengthened. The details are set to be in the finance bill. I haven't seen the details, but on both grounds, I think an attempt is being made to strengthen the RBI's regulatory powers. Of course, what matters is what the RBI does in terms of supervision corresponding to this regulation. As you know, the important thing is how well the regulations are actually adhered to, and that is where the RBI has unfortunately slipped in the past.
True. Ma'am, the other headline grabbing news was the government laying down its intent to borrow in foreign currency. Old debate. Let me first ask you on whether you think we need to move in that direction at this stage or not.
Well, clearly the attempt, so as I said, linking up with what I earlier mentioned about the government's gaze having shifted away from fiscal consolidation, and knowing perfectly well that far from going down to 3.3%, it's going to climb up, especially if payment delays are reduced, and certainly if the nominal growth rate is below 12%, which it's certain to be. Then that being the case, I think the reason this borrowing in foreign currency has been introduced is so as not to roil the markets and raise expectations of yields on government bonds going up in the coming year. If some of the borrowing needs are met in foreign currencies abroad, then those securities are not going to be sold on domestic markets, and they will not have an impact on yields. Is this a wise move? No, I don't think it's a wise move. It opens us up unnecessarily to extreme volatility in the event of oil prices going up, which they well could, and the rupee falling, which it well could. So it's a gamble which the government clearly thought was worth taking at this juncture. There's no question about the fact that the clear motive of the government in the whole package that it has presented, broad as it may be, is to get growth going as an imperative almost. Everything else is secondary to that objective, and this too has been brought in as perhaps a necessary evil to combat the slowing down of the economy.
Ma'am, just one more question on that front. So I completely take your point on some of the risks, foreign currency risk, interest rate risk that you bring in by doing something like this. But if you look at the fact that the household financial savings pool has not been growing at the pace it has in the past, and that pool is being taken up by government borrowings, right. PSBR almost entirely, then perhaps this is a way to alleviate the crowding out fears. Right. And could it be done within prudential limits? So if your pool is 6% of government bonds are owned by foreigners, similarly within that you carve out something for foreign currency bonds or whatever.
Yes, I mean, look, the limits clearly matter. The macroeconomic situation also matters. The fear is if there were to something were to happen to the current account deficit, which could very easily be beyond because of some exogenous event, like oil price volatility. If that were to happen, then, and if that were to happen going forward at the time when these bonds mature, then we could be in a very tight spot. In previous years, the way this shortfall has been sought to be alleviated has been through borrowing from NRIs in foreign currency, not necessarily in rupees. But this time, the government is going all out, borrowing on international financial markets, not particularly from NRIs, probably reflecting a degree of confidence, projecting rather a degree of confidence of India on international financial markets, and thereby crowding in more foreign equity funding perhaps, and getting growth going, which then is the fulcrum on which the government hopes that there will be no external turbulence.
Does this,
external currency turbulence.
It does help also in the process of internationalizing the rupee, and perhaps, for those who believe that listing on the foreign bond indices is important, it probably has some bearing there, or does it not?
Yes, of course it does. But I think that kind of confidence is a little premature at this juncture. The Indian economy is severely resource constrained on multiple fronts. I have written about the severe water crisis in this country, which could just by itself torpedo the entire growth engine. So I would have much preferred to have seen more attention to these structural constraints domestically, to see more fiscal consolidation, more conservatism on that front. And I don't think this gamble of borrowing abroad at this juncture was quite justified, except, as you say, if it's really kept within prudential limits, maybe 5% or something like that, incrementally, then maybe it won't do us very much damage. But there are so many structural constraints within the Indian economy. There's water, there's the labor market, factor markets, land markets, and various other last mile things, like, for instance, export industries not getting their refunds on time from the GST mechanism. All of these things are very, very important factors constraining growth in India, and it's very important to take them on board.
Sure. Ma'am, a word on what seems like an attempt to get again credit flow going into the economy, 70,000 crore for bank recapitalization, although I think a lot of people hoped it would come with some governance reforms as well, plus the NBFC backstop in some way that they've provided.
Yes. Yes, the NBFC backstop was good, I think, although it has to be done prudentially, in the sense that distinction has to be made between well-managed and badly managed NBFCs. The 70,000 recapitalization of PSU banks, again, was needed. Once again, if it had come with more discretion, or perhaps it will be exercised with discretion, given more to well-managed banks and less to banks which clearly have been ill-managed from the inside, then perhaps it will get us to where we want to be. But I think in terms of making domestic finance available, more important than all of these are the bid to get the corporate bonds market going, to make it function more effectively. There are a number of measures that have been done there, and long-term bonds for infrastructure funding. Those, I think, are more standout measures than this recapitalization of banks, which is good, but as you rightly say, does not come with reform conditionalities. But perhaps in the exercise of that recapitalization, the conditionalities will come in.
Sure. As a last word, ma'am, sort of where you started off, the budget does something to sort of stabilize growth, and maybe some of the idiosyncratic factors that took us down very badly in the fourth quarter, like election uncertainty, etc., as it eased out. Do we start to see at least stability and then some recovery and growth, to your mind? I'm sorry, I didn't catch your last bit.
Just
wanted to see whether you see some sort of growth recovery, both on the fact that some of the election uncertainty, etc., goes away, plus the incremental steps taken by the budget.
Yes, there certainly will be some growth recovery, although whether we will see that in this current fiscal year, I don't know. I still think that the RBI's projection of 7% for the current year, remember that we are more than one quarter through the current fiscal year, and these measures that have been suggested, that have been mooted, they're not going to come into force or have an impact immediately. So I would say that quarter one of the forthcoming fiscal year is when we will truly see the growth impact. Certainly real growth next year as a result of all these measures will be much higher than 7%, perhaps even as high as 8%. But for the current fiscal year, I don't see much growth impact really happening, except maybe towards the end of quarter four.
All right, ma'am, I'll leave it at that. Thank you so much for taking the time to speak to us and give us your perspective on some of the budget measures. Thanks so much for watching Bloomberg Quint.